G'day expats, welcome to another episode of Expat Chat, episode 37, rounding out the year that was. I'm joined today with Brett Evans, my friend, colleague, business partner, who's the Managing Director of Atlas Wealth in the EMEA region, as well as a recently announced FS50 top financial advisor in Australia. How are you going, Brett?
Well, thanks, mate. Well, thanks. And to the folks out there, I'm joined by my colleague and friend and business partner and mentor, James Ridley, who runs the Australian office. He looks after Asia, the Americas, and for the first time, and the first of many, I should say, was also named a 50 most influential advisors in Australia. G'day, James.
G'day, Brett. Now, Brett, I don't know if I want to have that kind of pressure spelled on me as a mentor of yours. That seems like a lot of pressure, and I'm not sure if I can accept that.
No, mate, take it. Drive it like you stole it. That's what I say.
How you going, man? How's the sandpit treating you today?
Mate, obviously the name of the game is Omicron and all that sort of stuff. And like we said before, I'm just sort of ignoring it, until we get data. If you read the press, you would think that the world's about to come to an end. I prefer to focus on Christmas around the corner and having a nice break with my wife and daughters and, recharging after what has been a hectic 2021.
Yeah, that's right. I mean, this Omicron that's come out, it's just ridiculous, isn't it? It's interesting to see how share markets react and overreact. I guess it's classic example of this time of the year where we always talk about a news vacuum.
Yeah, look at the news vacuum and especially from the Australian market point of view, we always refer to the Christmas rally, which is primarily driven by the three biggest banks, ANZ, NAB and Westpac, who pay their dividends on or around the middle of the month. And actually, before we go any further, I just got to do the quick disclaimer to say that all information that you have the pleasure and privilege, can't even talk today, of hearing and seeing today should be taken as educational and should not be deemed as personal financial advice.
Absolutely. Okay. Now, Omicron, as you said, news vacuum, share markets, volatility, always very common this time of the year.
Yeah, look, it is. It's something that the market doesn't like the status quo. So it needs information to either drive it up or drive it down. And the market is I guess, magnanimous in what it does. It doesn't matter whether it goes up or down, but it needs to react to something. It bumbling along is not much of a thing. And putting everything in perspective right now, as we sit here, recording this episode, the market really hasn't got anywhere since August. It's quite interesting. If you go back and look at the charts, we've had peaks and troughs, but we've actually been a zero-sum game. And to me, it sort of personifies 2021, where I think people were a bit ambitious in thinking that 2021 coronavirus is all gone and we're getting back to normal. No, we're getting back to a more of a normalized state. But when you look at, the chronology of SARS back in the early 2000s and those sort of things, it was a two and a bit year venture before things sort of reverted back to the mean. So I think, I think you and I've always said 2022 is going to be the year. I'm putting my hat on middle of the year, May, June. I think that's then things will start to settle down. But leading up to that point, we've got to go through what we're going through right now. And there'll always be that knee-jerk reaction, both good and bad, to different scenarios. And Omicron's just the latest one. And to me, I just need to see a bit more data, from people who actually have a science degree. Sort of surprisingly, I believe them more than I believe a lot of other people who don't have a science degree. But
that's right. All these TikTokers and Instagram influencers. I know. It's very frustrating because it helps obviously just fuel this whole, not necessarily an anti-vax movement, but just misinformation around COVID-19 and
vaccine hesitancy.
That's right. And one important note you made there with most share markets sort of somewhat tracking right. When you look at sort of on the screen, the different indexes haven't done too much since August. It aligns perfectly when earnings season sort of was starting to wind up, towards the end of August. Most people, investors, portfolio managers, we've seen the hard data from the companies that have been invested in. We know how they're looking for the sort of the next 6 to 12 months. And now we're sort of fall into a bit of a hole where Yep, we feed off that news vacuum. Markets tend to trade places almost on a weekly basis or semi-weekly. And then it finishes off the end of the year. I wonder whether we'll get that December rally, that December kick, Christmas rally. There's enough spare capacity there still, so we'll have to wait and see.
Yeah, the market's a funny beast. And, I do often quite liken it to my youngest daughter on sugar when it comes to irrationality and that sort of stuff. And, as we saw on Friday when Omicron, came out, markets came down. But I wouldn't be surprised because the market is eternally an optimist, or she is, not sure whether it's female or male, or it. But it's eternally an optimist. That's why it goes up over time. Yep. It wouldn't surprise me if this week the market took umbrage in Omicron, saying, well, you know what, we're not out of the woods yet. Therefore, interest rates are going to stay lower. Therefore, that's good for equity markets.
Oh, yeah. I see where you're heading. Yeah.
So it'll find the silver lining in the cloud. That's for sure.
Yeah, well, that's the thing. I mean, what was unique about the announcement that came out with Omicron, and I'll admit, somewhat relied on you on Friday because I was lucky enough to be out on a hinterland getaway for 1 or 2 nights, enjoying Springbrook. But that being said, I mean, a lot of media publications were saying now is a good opportunity to buy the dip. So it's funny how some of them are reporting about the doom and gloom of Omicron when we'd actually know nothing about it. And the original paper that was published actually said it's very similar to Delta. So, that's not really anything new. And then you've then got a lot of people saying, oh, yeah, now's a good opportunity to buy this little dip, 1 to 2% dip, which will probably be completely gone by the end of the week because people will just keep throwing money back into the market.
Investors have a sensational demand for yield and returns. And while cash rates and banks are at 0.5, 0.25, they're going to hunt elsewhere. They're going to take on more risk by getting into equities, more risk than being in a bank anyway. And that's the thing. If looking at the charts right now, if we look back to that pullback back in September, when we had those that sell-off, we're still above those levels this September. So the end of the world hasn't happened. The wheels haven't fallen off. We've just retraced not to a same level as we were back in September. So we're still higher than we were in September. And that to me, it's that perspective. The funny thing about the markets the press that comment on the markets is they'll always talk about the down days, but not the consecutively updates. And that's why it's important just to once a month go and look at your accounts just to make sure you're heading in the right direction because, you wouldn't want to do it on a daily basis because some days you'd be happy, some days you'd be sad. Whereas if you look at over a 30-day period, okay, you get a bit of an idea, a bit of perspective as to where things are heading. If you look at your portfolio now, today, for example, you wouldn't be happy. But if you look at by the end of the week, you might be very happy. Who knows?
Yeah, exactly right. And I guess it's just it's the constant sort of certainty here at the moment, a bit of uncertainty around COVID-19. But I mean, if we look at sort of the year in review, I mean, still nothing for expats on the changes to residency. We haven't really heard anything from Canberra yet, have we? I wonder if we will by early next year.
I mean, I haven't had the time this year anyway to go through and look at how many sitting days are left in Canberra.
I don't think there are any, to be honest.
No, sorry, it's in next year.
Yeah, okay.
But before the election. So that's the thing. They've got an election coming up.
Yeah.
So let's say it's going to be, the question is the election going to be before the budget in May? Are they going to bring the budget forward like they've done in the past? Then they had the election in May. Like, there's still, I don't think that's why we haven't seen anything. Canberra has too much on their plate because they're trying to get re-elected. They're not worried about putting through new legislation. So
I don't know whether ScoMo holds as much favour as he previously did, to be honest. I think he has stuffed up.
Did he hold any favour?
Well, you're right. He was the next man in line, and it sort of the job fell onto him, to be honest. But I mean, initially he did pretty well as he could, and then I just think in the last 6 months he's really lost a lot of favour. And it wouldn't surprise me if you're right. They brought the budget forward. It's an election budget, it gives a lot, and then they hold the election, and then obviously they stay in house and hold their current seats. So we'll just have to wait and see, but. It is frustrating for expats just not having clarity because as that update mentioned in the budget, I went back and had a look at the original budget papers. It was 2 points and it referenced the Board of Taxation report, which was good, but again, they said, okay, we want this applying as of, I believe, 1st of July 2022. They do need to still release some sort of explanatory memorandum because there are some things within that report that need to be fine-tuned.
Yep.
But, if we go back and have a look at that high-level summary, it was just sort of, I think the most crucial part was that 45-day rule. You had, and this is mainly accidentally reinitiating your tax residency. If you're an Australian citizen and you're a non-resident and you come back for a period of greater than 45 days in the same financial year and you satisfy these at least two-factor tests, then you can accidentally trigger your tax residency. However, the caveat was that also if you're in a country where you had a double taxation agreement, which stated that you can only be a resident of one country, as well as based on those rules of that other country, you were still a resident, tax resident, then you'd be okay. You can maintain your non-residency. So I feel like they still need to provide some clarity around these tiebreaker rules, because that'll apply to a vast majority of expats, obviously not expats, unfortunately, in the Middle East. And
or Hong Kong.
Yeah, and a lot of, there are a few European countries that I suppose there
Portugal.
are large expat, Aussie expat bases. So some clarity needs to be provided around, if you're in a country that doesn't have a DTA, what does that mean? Can we still accept the residency rules pertaining to that foreign jurisdiction still under, whether you're accidentally triggering your tax residency? Big concern there.
Look, I mean, to me, I think there are some people out there who will enjoy the new laws because it takes away the grey space, the interpretation, the behavioural element of qualifying. Yeah. And if you reside in a country that does have a DTA with Australia, then your non-residency status in, say, Singapore, UK, United States, places with DTAs is solidified. You're definitely a non-resident. And even if you do breach the 45 days, you're still a non-resident anyway because of the DTA. So I think for those folks, 100%, I think it actually is a benefit from it. Obviously, to the property spruikers out there, they don't like these new laws, and the reason being is because taxable Australian property is an economic factor test, and there's a lot of people who, they will shy away from property if they don't meet anything else, so they can go in Australia for more than 45 days. So that's right. you can be an Australian expat living in the UAE and spend 90 days in Australia, as long as you don't own property. Simple as that. If you don't have property, then there's no economic factor test. There's no accommodation test. As long as you haven't got family living in Australia, then you only fail one factor test, which is the right of abode. So, I think we're going to see more and more expats. I mean, they're doing it anyway since 2012. Property's on the nose. I know in the last, I think I was counting the other day, in the last 3 weeks, I think it's 3 weeks, I've had clients sell over 5 properties in the last 3 weeks because they're like, these numbers are nuts in terms of the gains they've had. And they're like, but selling to strength, buying to weakness. And I don't know. I just think it'll be interesting to see what happens over the next 12 months because, I think the whole, if we could change the 45 days to 90, I think we would have the perfect non-residency rules out of any country.
Oh, yeah. Absolutely. I mean, think about it. I mean, remember, the day rule only applies per financial year. That means technically an expat can come back for almost half a year if they line it up correctly across 2 financial years. It's great. You're in Australia for we'll say 5 months just to be safe, 5.9 months. And you can hang out with your family, your friends, but you're still a tax resident of that other country. You can't come back in that same financial year, obviously. But providing a lot more flexibility, it'll be interesting to see whether they take any consultation reports, those sort of things into effect when they consider maybe updating that legislation. I agree with you, the fact that it does provide clarity. Right now, the rules are grey to a degree, especially when you apply that secondary tests. I mean, being from the 1936 Tax Act, they're no longer aligned to today's workforce. Changed. yeah, that's right. Shit has changed. Globalization, those sort of things. But I guess it does provide clarity when you have spouse and kids back home and you're the main breadwinner and you're overseas working, and there are ways that you can be a non-resident and still have kids back home and all those sort of things. It just means you cannot return for more than 45 days. Unfortunately, if they legislate it as it is, there is going to be a lot of hardline advice, especially for our clients saying, listen, if you're going home, you go home for no more than 45 days. If you want to hang out longer than the family, unfortunately, you need to do it outside of Australia. That is the reality of these rules.
Yeah, you just need to catch up in Bali, Singapore, Phuket. There's a lot of places that would be nice to hang out. And if you look at the extra tax you'd pay if you were deemed as a resident, it'd more than well and truly cover the equivalent cost of the resort where you're meeting up with your family. So, look, it's not nice, but look, I get it, in that if you're a non-resident, you have severed ties with Australia. So why would you want to be in Australia for 4 to 5 months? So I get that, because would an Emirati base himself in Australia for 4 to 5 months? No, he wouldn't. Would he go there for 90 days? Yeah, he would. So that's why I think the 90 days is allowable. But under the current rules, those who are complaining about it, they've had the best of both worlds. It's been grey, and they've been able to navigate that space because it's grey. But look, we'll just, to me, they've got to issue the bill. They've got to issue the explanatory memorandum that explains the bill. There's a lot of water to go under the bridge, and there's probably only, I reckon, 5 or 6, no, more than that, maybe 20 sitting days before an election next year. That's just me guessing based on when they normally reconvene and stuff. So there's not a lot of time for them to put this through if they want it through by 30 June. So, I think we'll watch this space.
Yeah, I agree. I mean, if they're going to do what they did with the main residence exemption, they did it in December, and then they gave us 6-7 months for expats to actively make a change or sell a property or whatever it might be. So if they follow that something similar, then you'd think we'd get something pretty soon. But it's just a bit of an unknown. But I guess, wait and see, and then we can get an update. I guess, big year, and obviously 2022 is going to be even bigger if that comes through. I have no doubt we'll be putting on a lot of webinars and seminars to try and educate expats on workable examples.
Yeah, look, where it's going to be good is with borders reopening, ignoring the whole hype about Omicron and how that's going to happen, because at the moment, nothing's reclosed yet. We'll watch that space closely, but actually get out and run seminars and webinars. To me, there's a lot of change going on for expats, whether it's managing expectations, whether it's optimizing your scenario. There's a lot of new expats, freshly minted, who are heading overseas for the first time that we've been talking to over the last month. And, life is getting normal. I said to a client yesterday, I think for those who do have vaccine hesitancy, I'm not sure how they would operate in an expat world now, where vaccine is pretty much mandatory. Certainly there's certain small freedoms in Australia, but the rest of the world, pretty much you need it. So it's going to be serious to see how that happens in 2022 and what that looks like. To me, the other thing with 2022, it's going to be, pretty much 2 years under the belt, when dealing with Corona. So you think from a match fitness point of view, there's a lot of known knowns. So we'll certainly watch and, see what happens there. But look, it's going to be an Australian election, potential residency rule changes. There's a lot going on, and no doubt there'll be a lot of politicking in the lead up to those elections as well too. So
I always wonder whether they're going to talk about the capital gains tax discounts, CGT, franking credits, because I feel as though pretty recently, maybe only a month or two ago, some Liberals were starting to agree with Labor's policy on the franking credits and the CGT discount on property for Australian tax residents. But if they touch those sort of considerations, it's going to change, I suppose, property investing as a whole. But franking credits, I mean, that's huge.
Well, you can't really sort of say it for some and not for others. That's the thing. It's just, I think that's why Bill Shorten fell over at the election, because he was singularly targeting one demographic of a whole ecosystem of investors. The big question is going to be is whether Australia follows suit with New Zealand in terms of cracking down on negative gearing. And to me, they have a massive problem to deal with. Absolutely monster. There was an article I was reading last night. I can't remember which paper in the in Australia was talking about this family bragging about their own 50 properties. I mean, yes, they've got equity, but it doesn't take a lot especially with yields being so low. That's my biggest concern. If yields were strong on property, they could sustain increase in mortgage interest rate rises. Okay, there's sustainability there. But when you're buying property with 1% and 2% yields and the mortgage is 2.5%, maybe 3%, makes you wonder.
Yeah, I know. And I mean, those yields, I mean, I would probably consider that more of a national average, to be honest. Because if you're buying in some areas where you can afford to buy in those areas, I mean, you're right, actually. If you consider Sydney and Melbourne, the yields down there are actually shit, to be honest, based on the property prices. Whereas Southeast Queensland, it's starting to turn into a new Sydney and Melbourne where yields are falling because you're having a lot of money, interstate money come up here, and even just a lot of returning expats buying up and those sort of things. So you're seeing a shift where you're right, income yields are falling on properties and they're likely to continue falling, but then you've got interest rates growing. If they touch depreciation, which I feel like they could touch depreciation
quite easily,
I feel like that's the only thing they'd first look at removing. Okay, consider grandfathering maybe some depreciation from a certain date, and then anything going further you can't depreciate. So that just means eventually, as properties rotate and there's stock turnover, well, those depreciation benefits will eventually be gone, but that'll take years and years. I'm talking 10, 20, 30, 40 years until properties are turned over. So it's a hard one, but I do agree with you, actually.
Yeah, that's my biggest concern is serviceability. It's not about the value of the property, it's the serviceability, with record debt levels. If Australians can survive rate rises, we're okay. But I don't know, when you see people with 50 properties, you just got to wonder how, if rates go from 2.5% to 4%, which is not a big jump in the scheme of things, how they're going to fund it.
I know. And I really wonder when interest rates will go up. I mean, governor seems to think that the cash rate's not going to move, but I guess we've got to remember, just because the cash rate doesn't move doesn't mean the big banks can't turn on the interest rate tap earlier, especially
they've already been doing it.
They have. CBA has moved so quickly. They upped their fixed rates last week, and then they did that again, but prior, about a month ago. So they went up, and then they've waited a month, and they've gone again. And I think it's 2.7 now, I think. And then if you can get sort of some wealth package discount, I think it was 2.59 or 2.49 before. So they've gone already, but I guess the fixed interest rates, as we've always said, it's a bit of an insight or look through the lens of the future, where the banks think they're going. But it's
fortune telling. And if you look at the CBA's results, which really shook up the banking sector, for the first time ever, the net interest margin was below 2%. And what that tells you, that's why the banks are pushing the rates up. So to those listeners and watchers out there, the net interest margin is the differential between what the banks take the money at and what they lend it out at. So if they can borrow it at, say, 1% and they can lend it out at 2%, then their net interest margin is 1%. The difference between their cost of the money and how much they're charging back on it. Years gone by, the net interest margin was at 4 and 5% about 5 years ago, 6 years ago. But now it's always been hovering around that 2 mark. But for the first time, a bank has got consistently below 2% at 1.9 something. So that is a concern. That's why the banks are pushing up. They've been in a fight over the last 12 months to get new business because margins are so low. They have to do the old economies of scale. We can't increase profits unless we just grow the book. So there's been a lot of competition in terms of new mortgages, getting those that business. But by doing that, they've cut their nose off to spite their face by cutting their margins. And that's why the banks are moving their rates up now, because they can't sustain below 2%.
Yeah. No, it makes sense. And I guess, next year, you're right. I think next year is going to be very interesting to see where the capital growth is on some of those major markets, what the income yields are, because there's plenty of forces at play at the moment. I'd hate to be a regulator trying to work out what to do. And when you've got, I guess, these other variants that are thrown into it, hard decisions, especially to keep everyone happy.
Well, if they want to keep the Australian population happy, they can't raise rates because people are defaulting anyway now with rates at record lows. To me, the only way to do it is slow down the supply of capital, e.g. APRA, serviceability assessment, take that from 3% up to 5%. So,
Yep.
and then
Oh,
do
good.
that. And then that will give us a robust picture of how people look in terms of being able to service a loan that's 5% above where we are right now. So,
Yep.
and that's a realistic benchmark. To me, there's no issues with that. So, yeah, I think APRA is going to play a big part of what's going on over the coming years in their ability to be able to RBA not having to tap the brakes in the economy, but to try and control that capital because it's capital. But it's interesting, we have seen, a lot of, the, what do you call it, clearance rates are starting to fall now at auctions and that sort of stuff.
Yep.
So it's going to be interesting to see what happens in the early in the new year, whether that trend continues. I think it will because you'll have more supply coming to the market as people are now coming out of lockdown. They can actually sell or move.
Well, you talk about lockdown. Have you heard these rumors of this massive resignation next year that's meant to happen down in Melbourne and Sydney and
they've talked about it globally. They've talked about it globally,
Yeah.
not just in Sydney or Melbourne. They've actually talked about it around the world.
Yeah.
Look, I think people, best way to describe it is, when you go on holiday somewhere and you go, I'm going to live here. And then you live there and it's different from being on holidays there. I think it's the same thing with this whole mass resignation. It sounds good. Ideally, from an ideology point of view, it sounds perfect. But whether you've actually got the gumption to go through with it and totally change everything. Look, for every person that put their hand up, I'd say, out of 10, I'd say probably one might do it. I don't think it's going to be as big as we think it is. Because yes, you will have companies that now allow you to work from different locations and location agnostic and stuff like that.
That's the thing. Okay, yep, cool, massive resignation, but what's the point? Most big corporates are now flexible with saying, okay, listen, we're happy for you to do 3 days work from home and, every other day or 2 days working in the office, that's fine. So most big corporates are providing that flexibility. One of the big four accounting firms came out the other day, I think it might have been Deloitte or another firm, saying, if you're based on your seniority, we don't care where you work in the world as long as you're getting your work done. So big corporates are starting to obviously align to that flexible strategy as long as the work is getting done or your projects are getting fulfilled or whatever it might be. So I haven't agreed, but I keep hearing about it. Massive resignation, especially in the southern states. Queensland, it somewhat would make sense because we've been quite lucky. But a bit of an exodus out of the southern states to either head overseas or head up north.
I think we will see an exodus overseas. I think we've already started to see. You and I both are very busy right now talking to folks who are looking to become newly minted expats.
That's right.
I think there's a lot of expats who came back through the pandemic who will come out as well. Both of us got a lot of clients in that position, but also you virtually got, pre-COVID, an Australian tax resident, it was at 1.4 Australian tax residents left the country every minute pre-pandemic for a period greater than 12 months. So you've now got this 2-year demand that's been bottled up that's about to, like a genie bottle, about to be let out. So I think 2022 will be a year of a lot of people, heading overseas, and they were just about to move to Hong Kong, London, Dubai, Singapore, in April 2020, and then COVID happened and everything got squashed. So those people are still there. There's people this year who are planning on going who haven't left yet. They're still there. So I think there's going to be a bit of a brain drain coming in 2022. Whether it's going to be mass resignation for other reasons, I don't know. I can see it from an expat point of view, 100%. And it's already happening now.
Yeah, no, I agree with that. I think a lot of expats that were on great roles, great cash flow, career, I suppose, pathways that were overseas that unfortunately were forced back to Australia because their role, the money dried up, whether it's the case they're working in those particular industries that were impacted really badly. You look at tourism, you look at aviation, or, even just hotels in general. And then, you've got your type of expats that work for startups and techs, whether it's in sort of your Southeast Asian region or the US. A lot of those roles will start to come back up, and they already are. Those are the types that I've been speaking to, and you're probably the same, to be honest. And I think as soon as those roles are open, obviously most borders are reopened. I think you're right. We'll see a bit of a mass exodus, but a bit of an expat focus.
Exactly. And I think, looking at this region, Saudi's spending an obscene amount of money. There's a lot of Aussies moving to Saudi right now. UAE, in competition with Saudi to try and maintain their competitiveness, has made and passed through a lot of legislation that makes it more expat friendly. We're seeing an expat exodus out of Hong Kong with what's happening with, politically with China and those sort of things there. Singapore's going to more of a localized model. They want to sort of hire from within, so to speak. But UAE sort of saying, hey, we're legalizing out of wedlock marriages. There's a lot of things that have changed, and we've got a blog article up on our website which summarizes the latest changes announced. But it is huge, and it is it's a chess game between different countries to sort of maintain their competitiveness, and while they're competitive, expats will move there.
Yeah, that's right. That's an important one you make, actually. A note there about the changes over in the UAE, especially around wills and estate plans, and how traditionally offshore Sharia law, which was very scary, let's be honest, about when someone passes away and how assets go to the state. They don't go obviously to next of kin, which is just ridiculous, to be honest. But those are some of the big changes. You can now still rely on, I suppose, an Australian will compared to having to go through the lengthy process of a local UAE will, again, under the assumption you don't have any local property in the UAE.
Yes, exactly.
A physical property, I should say, a house or something like that.
And look, there's a lot of other changes too now where you don't need a local sponsor to set up a business onshore. As long as you're not in certain categories like oil and gas and those sort of things, that sort of protecting those areas still. But long story short, if you want to set up a business in your Dubai, Abu Dhabi, you can have 100% ownership now. So they're mandating minimum wages for employees, maximum work hours. They're really polishing the value proposition of working and living here. And it's quite impressive to be here while they're doing
it. Yeah, absolutely. I mean, you're going through a period over there where you're seeing, especially Dubai, just grow. It's amazing to see what it's done in the last 20 years and where it's likely to go in the next, I suppose, 20 to 30 years, which is just ridiculous. Talk about growth, city growth. It's impressive how much money they have over there just to throw at these kind of developments. And that's probably not even an example of Abu Dhabi either.
No, look, it's Dubai is reinvesting, Abu Dhabi is reinvesting very quickly. The place is packed at the moment. It really is packed. So they're building a lot of infrastructure, which is good, because it's nice to see a government actually does that, rather than Australia, who will approve all this development work. And then there's still only a 2-lane road, and suddenly an extra 5,000 people move into that area and they wonder why there's gridlock. Whereas here, they just build these monster freeways in the middle of the desert. And then over time, with that urban creep, those areas will be filled in. And I haven't been here for a massive amount of time, but I've noticed areas the gaps are starting to fill up slowly. And then suddenly you turn around and the whole thing's filled. And it's like, okay, well, you can see what's going on.
I know. I'm hoping next year I can get back over there and see what's changed, because I have no doubt it would have changed, to be honest.
Since you've been here, the roads that we've driven on when you were last here, there's freeways now, there's flyovers, there's all these sort of things that weren't there, back in early 2020. So it's it's impressive to watch. To me, the sleeping giant is Saudi. There's a lot going on there. There's a lot. So and all for good things, both socially, politically and economically. We'll certainly keep an eye on that. But mate, I think we'll leave it there for the year. So as always, it's been a privilege and a pleasure doing these episodes with you. And to the listeners and the watchers out there, I just want to wish you everyone a very Merry Christmas from everyone at Atlas, both in Dubai and Australia. Keep posted on what we're doing, but take a break over Christmas. We won't be doing too much in terms of posting and updating in terms of information, because I doubt a lot will be coming out, but certainly we'll keep you guys informed in 2022, and have a merry and happy, safe Christmas.
Sounds good, mate. Thanks for your time, guys. Thanks for listening in. And Brett, as always, thanks for your time, and I'll speak to you soon.
Cheers. Thanks, guys. Thanks, mate. See ya.